In this video, I'm going to show you the journal entry to record the purchase of inventory. Now, the journal entry is going to be a little bit different based on whether the company's a retailer or a manufacturer, and also based on whether the company purchased the inventory on account, which means it was a credit purchase, or whether the company paid cash up front for the inventory. But what is going to be common across all the transactions is that inventory is initially going to be recorded at its cost. And remember that the cost of the inventory includes not just the purchase price that appears on the invoice, but also any costs that are incurred to bring the inventory to its intended location, which we typically call freight in. Okay, so shipping costs to get it to a warehouse or to the company's store, and to make the inventory ready for sale. So any inspection or preparation costs. So let's jump right into an example. Let's say that we've got a retailer, and we'll do a manufacturer in a little bit, but we'll start with a retailer. We'll take the company Walmart, and let's say that they agree to buy some biker gnomes from a supplier. Now, the price that they are going to pay, so they're quoted $198,000 as the price. But Walmart also has to pay, in addition to the $198,000, they have to pay an additional $2,000 to have the gnomes shipped to their stores. So the total cost of this inventory, the total amount that's going to go on the balance sheet initially for Walmart is going to be $200,000. We've got the $198,000 price of the gnomes plus the $2,000 of freight in. So we've got $200,000. Now let's assume that Walmart pays or purchases the inventory on account, which means that they are not paying cash up front for the inventory. They're telling the supplier, hey, bill us for these gnomes later. We'll pay you at a later point in time. So if that's the case, if there's a credit purchase by Walmart, they're going to debit the inventory account for $200,000, and they're going to credit accounts payable for $200,000. So accounts payable is a liability. So we've got a liability increasing here. We've got an asset increasing here. So assets go up by $200,000, liabilities go up by $200,000. Now, later, when Walmart actually goes and pays for the inventory, they would debit accounts payable to reduce the liability and credit cash because they've actually gone and paid the supplier. Okay. Now, let's assume, so that was a journal entry for a credit purchase of inventory, assuming Walmart initially bought the inventory on account, said we'll pay for it later. But let's say that Walmart had paid cash up front. In that case, Walmart would still debit inventory for $200,000, but instead of crediting accounts payable, it would just credit cash directly. This is assuming they immediately paid cash for the inventory and did not purchase the inventory on account. Now, let's say we're talking about a manufacturer like Boeing. So let's say Boeing said, you know what, we're going to purchase $6 million of aluminum to make airplanes. Remember, Walmart is a retailer. They're not manufacturing the products that they sell in their stores. But Boeing is manufacturing its products. It's building its inventory. It's not just buying it and then reselling it. So Boeing is going to need to debit an inventory account when it purchases this aluminum. But specifically, it's going to call it raw materials inventory. And Boeing is going to have actually 3 different types of inventory. So they're going to start with raw materials, and then as they apply direct labor, some manufacturing overhead costs, and start working on that aluminum, and they get a partially constructed airplane, they're going to have work in process inventory, and then ultimately finished goods inventory when the airplane is ready for sale. I've got other videos on that, my managerial accounting playlist. I don't want to go into that right now. It's beyond the scope of this video. The key is when they buy that aluminum, they're going to debit raw materials inventory. Okay, just like we debited inventory with the retailer, we're going to debit inventory, but now we're calling it raw materials inventory. Aluminum is the raw materials used to make the airplane. And they're going to credit, assuming that they bought the aluminum on account, they would credit accounts payable for the $6 million. But if they had paid cash up front and said, you know what, we're not buying it on account, we're just going to pay cash immediately, instead of crediting accounts payable, they would credit cash.